Today we examine why long-term stackers ultimately will beat COMEX and the big banks. Let's start with the question no one on financial television seems interested in asking. If silver is in shortage, if physical demand is exploding, if premiums are rising and retail investors are stacking coins like it's 2008, then why does the price keep getting pushed down on cue? Why does it fall at 8:30 in the morning? Why does it drop in the thinnest hours of overnight trading? Why does it collapse in seconds on volume that would take a small country to produce? And most importantly, why does the retail investor always seem to be on the wrong side of the trade? The answer isn't complicated, it's structural, because retail investors are playing checkers and the COMEX, big banks, are playing three-dimensional chess with leverage, liquidity, and the full architecture of the futures market behind them. Let's break this down calmly. No conspiracies, no drama, just mechanics. The COMEX is not a coin shop. It is not your local bullion dealer. It is not even a physical exchange in the way most people imagine. It is primarily a paper derivatives market, a place where contracts representing silver trade in massive size, often detached from immediate physical delivery. When you buy a silver eagle, you're holding metal. When a hedge fund or a bank trades in silver on COMEX, they're trading contracts, highly leveraged contracts, controlling thousands of ounces with a fraction of the capital. And that is the first reason retail short-term loses. It's leverage. A retail investor might spend $85,000 to buy 1,000 ounces of silver at current prices. A large institution can control that same 1,000 ounces with a margin deposit that's a fraction of that, sometimes 5%, sometimes less, depending on volatility. That means when prices move, institutions can deploy capital faster, in larger size, and in coordinated fashion. Now, add liquidity to the equation. The biggest banks on COMEX aren't just traders. They are market makers. They see order flow. They manage risk across books that include options, swaps, futures, and physical exposure. They don't just react to price. They influence it through positioning and hedging flows. Retail sees a chart. The banks see positioning data, stop loss clusters, and liquidity pockets. When silver starts running higher and retail piles in, often after a big green candle, what happens? Stops accumulate underneath, and when liquidity is thin, say during overnight trading, it doesn't take as much capital to push prices through those levels. Once stops trigger, forced selling kicks in. That selling creates more downside momentum, and suddenly what looked like a breakout becomes a waterfall. Retail calls it manipulation. Banks call it liquidity harvesting. Here's the uncomfortable truth. The futures market is designed for hedgers and institutions. It's optimized for capital efficiency, not fairness. It rewards size, speed, and access to funding. Retail has none of those levers or advantages. And there's another structural edge, time horizon. Retail investors in silver often operate from conviction. They believe in inflation hedging, monetary debasement, systemic risk. We're thinking in months or years. The big banks, they're thinking in basis points and time spreads. They're arbitraging between futures and months. They're managing options gamma. They're hedging producer exposure. They don't need silver to go to 1,000. They just need volatility and positioning imbalances. And volatility created when expectations diverge from liquidity reality. Here's how the cycle usually works. Silver drifts sideways, retail gets bored, a catalyst hits, inflation data, geopolitical tension, central bank comments, price spikes, social media explodes, silver is finally breaking out, retail chases strength, and meanwhile, large players who accumulated earlier, often during quiet periods, begin distributing into that strength. Not all at once, gradually, professionally. Then momentum stalls. Then comes the flush. And who gets shaken out? The leveraged retail trader, the short-term one, the options buyer, the late momentum chaser. But the banks, they reduce risk. They reset positioning. They wait for the next imbalance. It isn't personal. It's just structural. And here's where it gets even more interesting. The COMEX is a fractional reserve system for metal. The amount of open interest, paper contracts, often represents multiples of the metal registered for delivery. That doesn't mean it's a fraudulent market. It means most participants don't want delivery. They want exposure. Retail hears paper silver and assumes collapse is imminent, but the system is engineered to cash settle stress before it breaks. Margin requirements rise, position limits tighten, volatility halts trigger, liquidity providers widen spreads. The pressure gets released mechanically. So when retail investors say this time the shorts are trapped, they underestimate how flexible the structure is. Big banks don't operate naked and blind. They hedge across global books. They can source metal through OTC markets. They can borrow. They can roll contracts forward indefinitely if capital supports it. Retail cannot. And that's the core imbalance, capital depth. When silver drops $5 or even $15 in a day, like we've very recently seen, a retail investor feels pain immediately. Their account shrinks. Their conviction is tested, and emotion may creep in. For a multi-billion-dollar institution, that move is inventory fluctuation. It's managed inside a risk framework. It's offset against other exposure. Emotion versus structure. Now, does that mean retail should give up? No. It means retail needs to understand the mechanics, the battlefield. If you are buying physical silver as long-term insurance, you are not playing the same game as a COMEX desk. You are opting out of their volatility cycle. You are removing counterparty risk and ignoring daily noise. But if you are trading futures leveraged ETFs thinking you're going to squeeze multinational banks with a Reddit thread, you are stepping into their arena and you are on thin melting ice. And in their arena, they control funding, margin, and liquidity. The irony is this: retail investors are often directionally correct. They're correctly identified inflation trends, they correctly see currency debasement, and they correctly sense systemic fragility, but they lose on timing and structure if they're in paper. Because being right in thesis does not guarantee being right in positioning. Markets are not morality plays, they are capital allocation machines. And markets, as we've seen, can be irrational longer than the short-term paper trader can remain solvent. So what changes the equation? Scale. True structural shifts, sovereign buying, sustained physical drain, regulatory overhaul, or a funding crisis that impairs dealer balance sheets. But absent that, the cycle repeats: spike, chase, flush, reset. The big banks survive because the system was designed for them and by them. Retail survives by understanding that reality, not by fighting it blindly. And that's the takeaway. The question is not whether silver is undervalued, which it is. The question is whether you are trying to trade a derivatives market built for institutions with the emotional bandwidth of a retail account, or one is a conviction asset, the other is a liquidity battlefield. If you've confused the two, you'll keep asking why the price always seems to move against you. It is not random, it is structure. And until you understand the structure, you're not investing. You're providing liquidity to someone who does. So how does a long-term stacker ultimately win? They're focused on the long term, of course. The long term. I'll say that one more time. The long term. Daily dips are potential buying opportunities. Any trade of fiat into silver is a trade out of inflated funny money and into a historically sound store of value. When history plays out, as it always has in the past, those with gold and silver will have a real store of value, and those without, they will be burning those empty paper promises in the streets when the day comes. Maybe not today, maybe not tomorrow, but in time and with certainty. As it has always been in the past, so it will too be in the future. Thank you for watching all the way to the end. As always, take care of yourselves and each other, and build that stack!